Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark says Shanghai is exhibiting classic post-bubble behavior. The Aden sisters from AdenForecast.com are big on high and biotechs, and long-term cycles are bigger players in the markets than you might expect, says InsideTrack.com editor Eric Hadik. We'll talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy, Vancouver. Welcome to This Week in Money, Ross.
Nice to be with you, Jim.
What's happening on that very exciting, very volatile Shanghai market?
Well, we are still playing the classic post-bubble market over there. Following that big May high, we corrected all the way down to the 200-day average, gave back half of the whole advance. Bounced into a week and a half ago, just a really, really nice little two-staged rally, and that recovered just shy of 50% of the move that it had to the downside. So it's just starting to coil here. And from that high, then this week we came down and retested the lows again. Now, this is important because we've seen the backside of bubbles like this in the Nikkei back in '89. We saw it in the gold market in 2000, or in 1980, and in 2011. So what we're looking for here is the range to start to tighten in, and pretty much what we've seen is the top and bottom end of the last 6 or 7 days. If we start to break outside of that, then we can look for concerted move in the direction of the breakout. Probability at this point still is pointing that a break below 3,500 on the index probably gives up another 500 to 1,000 points there. If that's the case, it's going to have an impact in other markets.
Now, the way they've been trying to deal with the downturns is freezing so many stocks. Is that common?
It's very uncommon. This is the type of action that's just clearly not warranted. You create more anxiety as far as the investors are concerned when you prevent them from trading. The classic example in North America occurred just after 9/11, when everything here had a halt on trading for the week. And by the time you reopened, we had a series, off the top of my head, I'm going to say it was 5 or 6 consecutive days on the downside, and turned the corner from there and rallied back well above where we had been when the news broke there from 9/11. So in terms of what's going on in China right now, day by day the stories change in terms of what the government is saying and doing. And they would be best off to just stand aside and let the market resolve itself.
And when has a government ever resisted the chance to interfere?
Oh, it doesn't matter whether they are in Europe or North America or over in Asia. It's too tempting for them to not do it because they want to show that they do have control, that they are that they are the authority that can manage things.
And how well do they really manage it?
Well, take a look at what's happened since the advent of the Federal Reserve back in 1913. They haven't done the best job. Speaking of sort of this side of the water, North American markets, pretty choppy week. Started off on a negative note, turned the corner very well, but the indices look a lot better than the general market. When you take a look at the internals, we're still seeing a lot of weakness. The number of stocks that are rallying is fewer, but they are some of the big cap names like the Amazons, the Facebooks, the Googles that are having these large moves, and with their high capitalization, they're making the indices look better than truly is happening on the internals. We said that we should be watching the biotechs, the the pharmacares, the health cares like the IYH, and the financials on the U.S., that would be the XLF, the ETF on that one. They've all this week corrected back to their 50-day averages on the first breaks. They've overlapped their breakouts, and I think it'll be very important to see whether the rally that we had in the second half of the week can take hold. If we start to ease back through the levels that we had at the beginning of the week, those support levels, I think that would imply that the deeper correction is underway.
People have said usually in the summer you can pretty well ignore your stocks. Is this year an exception because people are expecting a major correction?
Well, every year you tend that you've been in a strong trend like we have seen here since 2009. Every year that moves along, people are anticipating that, the big correction is around the corner. And clearly you tend to then get more than usual volatility just because people will bid up when things are good, seem good at all in terms of the economic news coming out on a day-by-day basis. But as soon as there's anything negative, then there's this vacuum where you drop very quickly before you find support. So that type of volatility, now that we are 6 years into this run, becomes bigger than normal. What I have looked at historically is that as long as the corrections on the broad indices continue to hold at about the 5 to 6% level, which is what we saw into early July, then that's fine. As if you start to move through that level, then 10% becomes your next threshold to be watching. And in good solid bull markets, you can have those 10% corrections and then you continue on quite nicely. If we were to violate that 10% rule, then because we're so long in the tooth here on this run from 09, the chances of a big correction more in the 20% variety really come to the forefront. So that's I've got catalyst points there that I will be watching for, and it's something that we have to be more and more aware of as the years progress here.
Ross, thanks a lot for chatting with us.
More than welcome there, Jim.
My guest has been Ross Clark, Investment Advisor at CIBC Wood Gundy, Vancouver. If you have any questions for Ross, you can email him at ross.clark@cibc.ca. Coming up, Marianne and Pam Aden on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guests are Marianne and Pam Aden of the famous Aden sisters. Their website, adenforecast.com. Welcome to This Week in Money.
Thank you.
I was just wondering if perhaps we could start off with the bond market, some interesting movement recently.
Everyone is waiting for the Fed to raise rates. So this has been on everyone's mind and causing the markets to react to this very closely. So now, but we're seeing that bond market has been in a bull market for a year now, or over a year actually, a year and a half, and it still has, we think, one more leg up to go in the bond market, and we think it's just getting started right now, which means interest rates, long-term interest rates, like the 10 and 30-year yields, are going to head down, to be seen how down, if it's going to test the lows or not. But we see that's more like from now till the end of the year than having a raising rate. So it looks like more likely to us that the Fed will probably stay unchanged for a while longer.
Why do you think they're so keen on raising interest rates in the short term?
Well, because they want to think that the economy is doing fine, and exactly what the reason why we don't think it's going to be possible to raise rates, perhaps a tiny, tiny bit, but not much, because the economy isn't doing that well, and it would hurt the economy to have rates go up.
Taking a look at the big markets, the Dow, the S&P 500, what do you think's happening there?
Well, those markets have really been doing well. The stock market is still bullish, and it looks good, and I think as long as rates stay low, stocks will continue to, if it just chug a little bit higher, they will continue to remain in a bull market.
The Dow Transport, is that the bellwether that tells us what's going to happen to the stock exchange indices in the near future?
Well, it's interesting you bring that up because just recently, transports, well, as you know, this whole year they've been going their own way. They've been declining while the rest of the market has been moving up. But just in this week, we've had a nice sharp rise, and looks like if they continue to head up a little bit, say above the 85.50 level, that will confirm that they have the bulls, and then it'll be a good overall for the entire, not only U.S. market, but the global stock markets as well.
So they really do tell you what's going to happen in the near future.
Yes, it's something. In fact, the transports are what we're watching now mostly. See if they can keep going up, which would be a big deal, or if they're going to just turn back down and kind of head lower. And if they do, that would be negatives for the global economy.
What do you see happening on the world markets right now?
Well, the world has generally been sluggish and lagging, and there's basics in part because of the strong U.S. dollar. Also, all the world is kind of suffering under this deflationary forces, the deflationary pressures that are big, that the U.S. market heads higher, and since the world stock markets generally tend to move together, if the U.S. market heads up, it'll be a good sign for the rest of the global stock markets.
Were you surprised to see Shanghai climb so high, so fast, and then take a sudden dip?
Well, it's just been a very volatile market, and if it does come down, it will affect the world market, stock markets.
Was it a factor that so many of the Chinese people who invested in the stock market had no experience whatsoever with this, because before they never were allowed to get into a stock market?
Exactly, which makes them even more nervous. And in fact, an interesting statistic came out this week showing that new investors, they're at a record low for the records they have of wanting to come into the market right now. So yes, you can imagine how nervous a new investor would be, and when someone who's not used to the fact that you could lose money in something that moves. So yes, definitely that has an influence.
Because I heard from people in China, they had so much confidence in their government maintaining a high market, they were absolutely shocked to see a 35% decline.
Yeah, exactly. Like that's why they're saying they're having the doubt: can the government really hold it together or not? Is it too big for them to hold, or can they, or do they want to hold it that much? And we see that they're going into the gold market, gold exchange. A lot of investors are going there. In the meantime, during all this volatility that's in the recent weeks.
And of course, China itself has been on a gold buying spree the last 4 years, and they urged their citizens to buy as much gold as they could. Was that good advice and a good move by the Chinese government?
Oh, we think absolutely. To get the people in the mindset of investing for the long term and have a tangible asset in their favor, we think that's very admirable, actually, for the Chinese government to do that for their people.
Do you think other governments should have been doing that?
Well, granted, we have had a down market for the last. In September, it'll be 4 years since the peak of the gold market. But when we see them buying up now at these lows, anything like right now, it can't even hardly stay above 1,100, and that's another discussion. But and it could go a little bit lower. But when you look at physical gold versus paper gold versus where the market is today, we think that to buying physical now is a very good thing, and it has been this year, even though it's down from the, so this is where it is for them to be buying and just holding for the long term, which is actually any investors is a good thing, the physical.
On gold and silver, what do you see happening with those markets?
Well, right now they're just trying to get over the fact that they fell a lot a couple of weeks ago, and so this looks like probably the last leg down in the bear market. We see so many people throwing in the towel. We see the serious trouble the mining is having. It's like this looks and feels, and not only looks and feels, but also when we have done studies on the big picture, it looks like this year and into next year was the likely time to see a major, meaning mega major, in the gold market. This could very well be the last leg down, which could last a few more months, could go a little bit lower, but we're already seeing that big disparity once again in the physical market versus the paper market. And what's been really one of the movers in one of the reasons gold has been so volatile. And so we think that, yes, we're getting closer to the lows now than we were before, and we're optimistic in seeing that we're like looking over the valley right now.
Are gold miners a good thing to look at right now?
They're the most hated market right now. So, yes, there are some good buys in there. Yes, you have to be careful. They're consolidating, but there will be some good solid ones. And, again, there's some really good value out there. And this is what you have to look at when you're looking at them. Like, again, some people say don't bother trying to catch the falling knife. But in the case of gold mines, we wouldn't buy like now, like we have. If you have it, we wouldn't sell it. We would hold it, and there's some good buying areas over the next 6 months.
What about junior miners?
Well, it's interesting that juniors have been holding up better than the seniors last down wave, the last month, which is interesting. Usually juniors will get beaten up more because they're more speculative. But in this case, as an index, and we're not sure what it's trying to tell us, but it is something that we're keeping an eye on. So juniors have been less weak as an index, not as an individual stock, than seniors.
Is that perhaps they've taken up such a beating they just can't get any lower?
Well, that could be, but then again, as juniors, they could go out of business. So we're not so quick to want to jump into juniors. We would want to wait a little while longer. In general, we definitely think there's some good value coming right up.
What do you think is going to happen to the crude market? A lot of speculation on that.
Yeah, and that's another one that just fell out of bed well, you know about the big fall last year. So, yeah, it's just been sitting at the lows, and it is in a bear market. That's all we can say about crude. With the commodity fall, actually crude kind of led that huge fall in the commodity world. The base metals followed, copper followed. So did a lot of the commodities in general. So it's been a really hit market. The bear market's intact, and we're watching to see if the lows are going to be taken out. So we're kind of keeping our eyes on the 44 level for the low side. But, well, you see, if you want to look at the bigger picture again, 40, and it's unlikely to go much lower than that, but it's certainly not out of the woods yet.
Has it been a factor at all that there's more and more talk of electric cars being more viable as a large market? Has that affected the price of oil at all?
Well, it probably has a little bit, but we don't think that's been a major factor, simply because we think it's still new. I think that's something to keep an eye on, and it could affect oil, definitely, as we go forward. But we'd say so far it's been probably not as much of a factor as some would like to think.
Agriculture stocks, how are they going to perform?
Well, some have been bouncing up from the lows. They're one of the first ones to go in the fall. But again, they're not out of the woods yet. They're looking like they want to stabilize. We're watching very closely to see what sector and what individual ones are going to be doing better. But for the most part, they are looking promising, but they're not a buy yet.
Biotech has been one of the shining stars on the stock markets over the past few years. Are they going to continue to be strong?
Well, they've been really one of the, as you mentioned, they've been our top recommendation in this market, and we've really been very bullish on them, and they still look very, very good. We like the NASDAQ Biotech in particular, and we've been very, very happy with the way these have gone forward, and they've really been a major market leader, and we don't see that ending anytime soon.
What about the high-tech sector, Amazon and Google and Facebook, things like that?
Those have also, they've had their ups and downs, but as a sector, they've all been, they've essentially been the market leaders as far as the U.S. market goes. So we like them. Yes, we like the tech stocks.
Is there a danger people will become so enamored with them they're setting themselves up like the high-tech stock crash back in 2000?
Not yet, no, because the NASDAQ barely at a new high, and it's not anywhere near the speculative frothy levels it was back at the end of the 90s. So we still think it looks good, and it's bullish, been a market leader, so we're still recommending it.
Is there any other market that we should be looking at that perhaps has been overlooked?
Well, Pam mentioned the bonds, and I know they sound as boring as could be, and they're probably getting close to the end of the line, but they're not there yet. The long-term treasuries have looked good. Consumer discretionary stocks have looked good. Home construction, medical devices. So there's those have been markets that have been doing very well. Good, solid leaders tend to continue being the leaders. So we like those. And then the physical gold is something that we would say that, only because they're at very good value levels right now, and they're probably getting closer to a bottom. So those would be our favorite picks right now. And we think the currencies, we think the U.S. dollar's probably embarking on a decline. We think it's probably going to head lower, and that would be good news if it continues to decline here below, say, 93 on the U.S. dollar index, would give a clear signal that the currencies, the British pound, for example, we like, the euro, those would continue to really start moving up. They've been moving up lately, but we think they could head a lot higher.
Any outlook for the Canadian dollar?
Yes, again, it's been closely moving with oil, but we like oil. Like we said, that oil has a strong base at 40, and so we're seeing the beginnings of a small bottom in Canadian dollar. We generally, overall, really like the Canadian dollar. In fact, it's in our recommendation, and at the level it's at now, it doesn't mean its lows are over, but it's it's closer to the lows than anything right now. So commodity currencies like the Canadian dollar and like the Australian dollar, New Zealand dollar, they all much move similarly, and they're all looking like they're looking for a bottom, but it's getting closer.
Could you perhaps tell people how they could subscribe to your newsletter?
Oh, thank you. I know if they would like to, please go to info@adenforecast.com. And in fact, we have a special going on for your listeners. It's like a $55 trial if they'd like to for 3 months, and it's a monthly letter, so that'd be three issues plus a weekly updates we do every week. Every Thursday we do updates, and if they'd like to buy a special for a year, we're offering a special. So we'd be happy to have them get to know us.
Thank you very much for being our guests here on This Week in Money.
Well, thank you very much for having us. It's our pleasure.
My guests have been Marianne and Pam Aden of the famous Aden sisters. Their website, adenforecast.com. Coming up next, Eric Hadik on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Eric Hadik, editor of InsideTrackTrading.com. Welcome to This Week in Money.
Thanks for having me, Jim. I'm glad to be here.
Now, Eric, you're a first-time guest on This Week in Money. Maybe you could tell us a bit about Inside Track Trading.
Inside Track is a advisory service that I do research and analysis into primarily the financial market. And, that can include everything from futures to overall equity indices to precious metals. But I also apply the cycle analysis that I do to everything from geopolitical events and even things as esoteric as earth disturbances, and just showing that so many things in life are cyclical, and there's a time periodicity to everything that happens.
Now, if somebody did subscribe to your service, are there different levels of it?
Yes, there are. The flagship publication was a monthly newsletter, which I call Inside Track, and that takes a little bit more of a broad stroke perspective, but also deals with longer time frames as far as looking out into the future and longer term trends. That publication has the potential to also subscribe to some intramonth updates to supplement it, but actually what's become the most popular publication is the Weekly Relay, which is more short and intermediate term, more numbers intensive, does not get into things like I alluded to as far as the geopolitical cycles and earth disturbance cycles. It just focuses on the specific markets we cover, the trends, and where signals would be generated in the coming days or weeks. So they're the two main publications, Inside Track and the Weekly Relay. And then there's a number of special reports and other supplementation material that we also offer.
Now, Inside Track has an interesting spelling, INSIIDETRACK. Why two I's inside?
When I first started this newsletter over 20 years ago, I was trying to figure out how to convey what it was focused on or what it was addressing, and I came up with that acronym, but it also kind of worked into the theme of the overall publication. So Inside, with that extra I in the middle, is an acronym that originally described the primary markets that I was focusing on. The IN stood for inflation markets, which included all the commodities, gold and silver, precious metals, anything that you would see related to inflation. The SI was stock indices, both domestic and some global indices. Then the extra I was for interest rates, focusing on the bonds and notes and Eurodollar market. The D was for the dollar, but also foreign currencies linked in with that. And then the E was for energy markets, oil, natural gas, crude, heating oil, unleaded gas. So that was the reason, and it didn't hurt that something a little bit misspelled like that catches the eye a little bit more, and so that was partially the intent as well.
Eric, you've made a lot of important market calls using short and long-term cycles since the 80s. Could you maybe give us what your short-term cycle outlook is?
My short term, it certainly would depend on the markets in question, but we are right at a time when, in gold and silver in particular, the short-term cycles are right now aligning along with a lot of longer-term cycles, both of which have been anticipating a low in gold and silver, ideally in July of 2015. The longer-term cycles have been negative since 2011. And looking forward to this time frame in mid-2015, but then the shorter-term cycles also started to corroborate that as we got closer and really pinpointed a 2-week period of July 13th to the 24th. That's 2 trading weeks, in which the greatest synergy of cycles and also a lot of the technical indicators that I use to corroborate and to filter those cycles, all of that came into play, was all converging and really increasing the probabilities in my work for an important low in gold and silver. So where they're concerned, I think we are right in the time frame based on short-term cycles when we're going to at least get a decent bounce. I could see it stretching into mid-September, but then a lot of confirmation has to occur in the meantime for that to show that the intermediate and longer-term cycles are beginning to turn up as well.
So what are those long-term cycles you're looking at?
Well, one of the longest term that I have really been focusing on and getting a lot of interest generated as well is a 40-year cycle that I contend has governed America since its inception and has timed with uncanny precision, an ongoing struggle, battle, however you want to classify it, over currency, the dollar versus gold, and related economic struggles within that, which you could, if you wanted to stretch it that far, talk about the control of the country, the population, the currency, because really the control of the currency is the control of the people. But I'm not trying to go conspiracy-minded with that. I'm just saying that is a very unique struggle that I have seen, and if I try and make this brief enough, but just to recount how this cycle has unfolded, if you look at the period from 1773 to 1776 and then on to 1781, so really there's a whole 8-9 year period in there, but the 1773 to 1776 period started out with the Tea Act in 73, and then the revolution and the first shot fired in 1775, and Declaration of Independence in 1776. But at the same time, first you have that tea tax that is really a currency-related issue, but you had the colonists issuing their first attempt at a currency, the continental, in that time frame, a currency which ultimately very quickly saw its doom from 1775 to 1781. So you had that battle going on where economic, currency, even gold-related, it becomes more and more gold-related as the cycle progresses. But then things kind of fell into a certain more trend or expected progression until 40 years later, when you have the battle for the rechartering of the Second National Bank, Second Bank of the United States. And that battle was really at its most heated from 1813 to 1816, exactly 40 years from that 1773 to 1776 period. And one of the individuals really leading the charge against the rechartering of the bank was Thomas Jefferson, and if you read many of his quotes from that time frame, you'll see his warnings against a central bank controlling the currency, ultimately controlling the people, and that it's even more dangerous than a standing army, and but ultimately in 1816, the Second Bank of the United States was rechartered shortly after you had the crash of 1819, and that whole period kind of culminated in 1821. So from 1813 to 1821, you had a kind of a similar battle, but it was more economic than military, as it had been 40 years earlier. Fast forward 40 years later, 1853, you now get the government shaving the silver in coins and basically devaluing the currency of the day. That leads to the crash of 1857, leads to the suspension of payment in silver at that same time, and then by 1860, 1861, the suspension of gold payment as well. So once again, exactly 40 years, and spanning from that 3 year of the first decade to the 1 year of the following decade, 1853 to 1861, another battle for the currency and for the economic control of the nation.
I'm going to say, what a coincidence. Those 40-year cycles not only are monetary, but they also coincide with major conflicts. The U.S. Revolution, the War of 1812, the U.S. Civil War.
Exactly, and I've talked about that as well, but also there's an overlapping 80-year cycle that has timed it even more precisely. If you're looking at the 1770s to really into 1781, which was the culmination of the Revolutionary War, to 1861, Civil War, to 1941, U.S. entry into World War II, which then would take you up to 2021. But yes, there's definitely conflict that comes into that, and you can read a lot of historians who also talk about really economic control is the driving force behind so many conflicts throughout history. That and maybe religious conflicts and not much else. Most of them come down to some form of economic struggle or power or control. But there again, so you move forward from that decade, 40 years later, in 1893, you had it was a silver bubble that was caused by the government first propping up silver, having to buy it on a monthly basis, which sounded amazingly, eerily similar to things like QE and buying a certain amount of bonds every month. Back then it was to appease the Western silver miners. They were buying a monthly amount of silver that they were legislated to do, created a bubble in silver, and then a bust from there, and you had the crash of 1893. You had the election of 1896 was one of the biggest battles over silver, gold, and the dollar. And with the one candidate, William Jennings Bryan, battling against the gold standard, but in favor of a silver standard, and he ultimately lost, and the gold standard was reenacted in 1900. So right to that 1900, 1901, you're right at that 40-year period again. And as a little aside, it's interesting, don't know if you've ever read or heard some of this information, that entire battle and that election is really the theme behind The Wizard of Oz. Have you ever...
Yeah, I've heard something about it, that it was connected to economic markets.
Yes, and that I guess originally Dorothy had silver slippers on the gold path, that Hollywood was the one that made it into ruby slippers, probably stood out more or whatever the case. But her silver slippers on the gold path was symbolic of the battle over a silver standard versus a gold standard, and each of the, during that whole election campaign and battle, Bryan was known as the Lion, but once he lost, he really kind of moderated his argument, and that's where the Cowardly Lion came into play. The Scarecrow, I think, was dealing with the farmers, and the Tin Man with manufacturing, and so it's very interesting to hear, and the book was written right at that time. So it's interesting to kind of see the underlying theme or origin of that, and suddenly to put it into a different perspective. But from 1893, you go forward 40 years. You have 1933, which is when Roosevelt issued the executive orders banning and confiscating gold, and then in 1934, silver, and leading to shortly after, you had a second stock market crash in 1937, and then the whole thing kind of culminated in 1941 when the entry into World War II is really what brought the U.S. out of the Great Depression, the doldrums. So that 40-year cycle, again, was right on track starting in 1933. And then 40 years later, 1973, you have the collapse of Bretton Woods, which really was all about currency and gold's role in that, or lack of role. And that led to, in 1976, an agreement that a lot of people aren't very familiar with, but it's called the Jamaica Accord, which was basically the global certificate of divorce between fiat currencies and gold. And it was a treaty or agreement that kind of put into writing, finalized, that not only the dollar, but so many of the global currencies no longer had any link to gold.
We're speaking with Eric Hadik, editor of InsideTrack.com. So what do you see happening with gold and the U.S. dollar?
That, to me, is why for the last 10 years I've been writing about the period between 2013 and 2017, 40 years after that period, when I thought we would see a major shift in the dollar, first a kind of a crash in gold and silver, and then a new advance to start in the middle of that period, an initial surge in the dollar, but then I think after mid-2016, that's going to take on a whole different trend. And behind the scenes, I was contending that we would see a major shift in the global approach and perspective towards the dollar, and a move towards removing it as the reserve currency of the world. It still may play a big role in a basket of currencies, but the other thing, going back to 1973 through 1975, that's also when, starting with Saudi Arabia, agreed to price oil in dollars, which basically was like a shift. You had the Bretton Woods collapse. You had the oil weapon really being wielded during the Yom Kippur War, and then the agreement to price oil in dollars, which basically gave the U.S. kind of carte blanche to pretty much inflate their way out of whatever struggles might come for the next 40 years. And I think that ultimately that whole decision is going to come home to roost and have a dramatic impact on everything from the dollar and gold to stock markets. And I'm looking at the period of 2016 to 2017 as being a very critical time where that's concerned.
So that would be kind of a flip-flop between the U.S. dollar and the price of gold?
Yes. And there are a lot of other reasons that I think that I've kind of termed 2016 the golden year, because I think that there are going to be a combination of factors that both geopolitical, economic, currency-related, that support the price of gold during the year of 2016, but that we would have a bottom intact before then. That would just be the time when it really becomes obvious to most investors that gold is regaining its luster. And
at the end of a 4-year cycle, where would the price of gold be there?
That I am only beginning to kind of analyze and discuss, because a lot of it has to do with where it's bottoming, what certain trend indicators I use are saying about that. So I'm only beginning to get into that, and really haven't published anything as far as the upside targets yet, although that's my intent for the coming months, is to start discussing the upside objective for this.
What kind of market signals would you be looking at to make those predictions?
Well, I have a lot of proprietary and technical indicators that I use, so to get into explaining them probably wouldn't be conveyed or communicated very well, but there are different patterns that I look for. One simple thing that would help corroborate it is if gold and silver by the end of 2015 could get back up to and ideally exceed the highs that were seen back in late January of this year. And that's a type of intra-year reversal pattern that I look for. It's more of a lagging and confirming indicator, but it's at least something that I think I can communicate fairly easily here. But just where a market makes a significant high in the beginning of a period, then drops down to a low in the middle of that period, and then by the end of the period has rallied back up and exceeded the early year high. So that would be one more lagging indicator, like I said. But there are weekly and monthly trend indicators that I use, that I explain in my publications. I don't focus on a lot of fundamental events or signals. So as far as economic indicators or, different monthly numbers that the government puts out or anything like that, I really couldn't pinpoint any of them that your listeners could hone in on or focus on. So there are some signals, but they're all of a very technical nature.
And I was going to say, too, if they're numbers provided by the government, can you really trust them anyway?
Well, yeah, I shouldn't have even gone there. But yes, they're always skewed to look better than they are, and especially as you go into a election year. Doesn't matter which party's in control. It just tends to be, the numbers always tend to look rosier, and you got to believe that there are ways, either by just timing certain things, or it doesn't have to be an all-out conspiracy thing or control. It's just tweaking things to make them look better.
Well, we have a prime minister who insists Canada is not in recession and that he will have a balanced budget, whereas the parliamentary watchdog on the budget says you have $1 billion deficit. So, and we expect an election writ to be dropped over the weekend for an October 19th election. So you're absolutely right. They love to skew the numbers. The non-resource equity markets moved up steadily from 2009 into last October, but then we've seen participation drop, and it looks like only a few sectors and some big cap stocks like Google and Amazon have propped up the markets. Most stocks really have underperformed. Do you see this as a topping pattern or just a cleansing phase?
Let me preface that with saying in my work, my focus is on overall indices and not the individual stocks or even sectors. But with that said, I do watch so many indices that it does cover a lot of what you're discussing. Short answer, I do see it as a topping pattern. A little bit more elaborated answer, I've been watching. It's been very interesting to me to see the sequence of the various indices that have topped out, and not only topped out, but one of the key signals that I look for to confirm to me we've got at least a 3 to 6 month top and potentially longer is a weekly trend reversal signal. And again, I really can't explain the details of that, but that signal has to reverse, has to turn negative to tell me that the tops that have been forming are valid and are going to most likely continue to hold, and that the correction is going to continue to evolve. My point in saying that is, starting back in November of last year, you had the Dow Jones Transportation Average, which has actually led a lot of the major turns since the late 90s, and led them often by 6 months or more. And that index topped in November, and then a couple months later turned this weekly trend pattern down, which was also a lagging confirming indicator. But that was kind of the first signal for me. Then a little bit after that, the Dow Jones Utility Average topped out and ultimately turned its weekly trend indicator down. About a month following that, the Dow Jones Composite did the same thing, and then you kind of shifted to global indices, and you had the German DAX index top out, and at the time I had been discussing what I was calling the last man standing and thought that the European indices would top between March and June of this year. The DAX topped and ultimately turned its weekly trend down. And at a couple-week lag from that, the FTSE and then the CAC 40. And so it was this steady sequence. And then as we came into May and June, you had the NYSE index do the same thing, and by early June, by late June, it had turned its weekly trend indicator down. And all along, I was also focusing on the Dow Industrials and saying, okay, if and when this can do the same thing, we're going to have a stronger confirmation, corroboration to what these other indices are saying. And sure enough, just a couple weeks ago, the Dow Industrials did the same thing and triggered that same signal. So it's been this steady sequence, kind of like what you're describing, where these different sectors and different averages have turned down in sequence. And really, probably when the NASDAQ 100 and NASDAQ Composite do the same thing, and tech starts to give up the ghost a little bit, that will probably be when we see more of an accelerated decline take hold.
If there is a big correction, how severe and how long will it last?
Well, I'm looking at it in a couple of stages. Number one is I have another longer-term cycle that I discuss and have for a couple decades now is a 17-year cycle. And in fact, if I could just give a real little plug here, we also have two other websites. One is 40yearcycle.com with the number 40 and then the words year cycle, and 17yearcycle.com that focus on these two distinct cycles. But there's a 17-year cycle that has timed geopolitical crises and financial crises, and usually results in at least a 20% correction in the Dow Industrials and the major indices. And it's often been right in kind of the middle half of the year, between late April and late September. And so that was the first thing I was looking for in 2015, was to see a top by late April and about a 20% correction into late September, maybe early October, since October tends to be a very historical time of blow-off lows. So that would be the first phase of it. And just to give an example, if you go back 17 years ago, you have kind of the Asian financial crisis in 97 and then the Russian ruble crisis in 1998, which ultimately resulted in the Dow and the other indices seeing a 20% drop right in the middle of 1998. Lo and behold, here we have the ruble again, all last year and into the beginning of this year, plummeting. Then it had kind of a dead cat bounce for the last 3 to 6 months, and now it looks like it could be going into another dive, which often is that final capitulation sell-off that unnerves all the other markets. Often leading markets or the stronger markets can resist and resist and resist negative forces on the outside, but then all of a sudden there's that proverbial straw that breaks the camel's back, and in what seems like an instant, the stronger markets just turn on a dime, go from looking so strong to looking very unnervingly or alarmingly weak. So I could see something similar in this time period, and several of these markets and indices that I was discussing set their exact tops in late April, so it's kind of been following this pattern that I started describing over a year ago and talking about, looking at late April through late September of 2015 for the first significant drop in the indices. But depending on what comes from that, I could see an even larger overall decline into and through a chunk of 2016 that could then get up to your 30+% drops in a lot of the indices. But again, I really need to see what comes of the next 2 months before I would with more conviction say that I'm expecting that.
What do you see ahead for interest rates and the bond market?
I think that interest rates have definitely been trying to bottom, and everything certainly seems to look like they're looking for an excuse to turn up a little bit. The bond market had several major cycles topping in 2012, and it has corrected since then. So on a multi-year basis, I think that the top in the bond market is intact, but often it's this rolling over process that takes a long time, often longer than I expect, before bonds start to sell off and interest rates, longer-term interest rates, start to show signs of recovering. But that is definitely the general direction I expect. And if some of these things come to fruition in 2016, even what I was talking about with gold and silver, you might have a little bit of an inflationary scenario where that even prompts a little bit of pushing up of interest rates. And if the dollar does start to turn down in the future, that interest rate nudging could also be used as a protective maintenance for the dollar. So long term, I think that it is a steady reversal, but that is a slow but steady progression that's unfolding.
Which markets are you the most bullish on for the next 6 months?
For the next 6 months, that's a good question. I do think, as I said, that gold and silver are bottoming. I think that they should have an initial rally in there, but my more bullish stance for them is after that 6-month period, so in 2016. There are some commodities that I'm looking for important bottoms in here, the grain markets and a couple of others. So that, I guess that would be a rather general answer, because I don't know if I could pinpoint one market for 6 months, but precious metals would certainly be in contention for that classification.
Eric, could you again maybe outline your websites and how people can subscribe to your newsletters?
Yes. As I said, there are the two cycle websites, 40yearcycle.com and 17yearcycle.com, that provide a lot of this analysis and some excerpts of a lot of reports that have been published. But the primary website, InsideTrack.com, and as you mentioned, it's spelled with the extra I in the middle, so it's InsideTrack.com, has all of our descriptions of the services, links for subscriptions, and all of that administrative and structural information, as well as many publications and samples there as well. And there are a lot of links to that website from 40year and 17yearcycle.com. So ultimately, it's pretty easy to get to them. But that's the three main websites.
Eric, thanks a lot for being on This Week in Money.
Thanks so much for having me, Jim. It's been a pleasure.
My guest has been Eric Hadik, editor of Inside Track Trading, his website, InsideTrack.com. And that wraps up the show for this week. Thanks to our guests, Ross Clark, Pam and Marianne Aden, and Eric Hadik. And thank you for listening. Comments or questions for This Week in Money can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.